Let's have a look what I wrote here. Again, guys, before you see, like, you do any trading decision, remember, before you place any trade, you have to fully understand all possible outcomes of it. You invest your own money and you have to make your own decision and don't rely on anyone's opinion, even if it is my opinion. Okay, so guys, believe me, it's your money, so take care about them. Now, we have different type of investor in our group, and some of you might look for the long term. So it's long-term buy and hold strategy. You buy at 47, 49 levels, so that's where it could go, and hold until 73 or above. Possible waiting period 2-3 years, not 850, 85%. Okay, guys, zero is wrong here. So 85% profits plus dividends. Okay, now roll strategy, majority of our guys probably trade this way. So when you buy around 47, 48 and sell around 49, 51, so it gives you 10% quick profit in this particular case. So I just want to show back. That's if you trade just shares. If you trade options, it will give you higher profitability. Just a second, went to a different way. Just to want to explain you the way I calculated. So 47 is the lowest part. Okay, so here 47, 49 I buy, and if I buy at 47, I might sell at 49, or if it breaks through 49, I sell it around 52. Now for Ludon's strategy, Dory put 60. He's going to sell it here because it can close the gap and can close it pretty quickly. Okay, and the highest point is 73 based on fundamental analysis. These numbers, remember what we put in the table, we identify the ranges, so that's where we're going to sell 73 or above. Okay, but you have to wait until the earnings improved, and then we can see those numbers. Now, or use option strategies, sell naked puts, sell covered calls, and buy lip calls. For guys who are just doing the program, you're going to learn it all. Remember, it's not a problem that you don't know now, and that's how we look at this. So sell covered calls, sell naked puts. We can see the good thing about Intel, first of all, that they have 50-cent strike price difference. Okay, so which is fantastic for this price level. Also, they have weekly calls and puts, right? So 3 days, 10 days, 17 days. And also what they do, they have pretty low spread. Okay, we can see that 9 cents here. Also, I took it just before our event, and during the market when it opens time, maybe the spread will go down even lower. Okay, maybe 5 cents will be. So it's a pretty good one. So you can trade. Now, if you decide, for instance, to sell put at the money, so we can sell, for example, $49. We can get 60 cents, 7 cents. That would be time value. So 53 cents. That would be time value. It means that we're getting 1.3% until this Friday. Okay, so if the share price goes above 49 cents, we make 7 cents extra. So it's about 1.4% profitability. Now, guys, it looks like very low, 1.4% during like 4 days, but in general, multiply it by 52 weeks. So if you keep doing it every week and 1% every week, so it's 52% annual return. Okay, if you always right. Of course, sometimes you won't be right. You would have to hold your position a bit longer or do something about it, but still. So if you go for 10 days, look for the same strike price, $49, you get 92 cents. So it's 50% more than for 4 days, but it is 2 weeks. Okay, and if you go for 3 weeks, you're going to get 1.1, so it's less than 2 times, but the duration is 3 times longer. So if you're constantly looking at the market and you're more active trader, the most profitable trade will be short trade, selling puts, right? But if you cannot like look at the market all the time, so maybe for you it's better to go for a longer period of time, just do one trade, make 2%, and then to stay 3 weeks out of the market, don't look on at this there. Okay, similar profitability will be achieved if you buy shares and selling call. Okay, again, if you buy the shares, you're going to sell the call not instantly, but when you see it goes to resistance, or if you see it's turning down. It's like I did when I bought the shares where was it? I could see that green candle. So I expected it's going to go up. So because I saw this trend, I could see this low. I expected that it go close to 51, 52. And but then I could see next day it start going down. So I thought, okay, fine. It might continue the downtrend, and the risk was $44 at that stage. And what I did, I instantly sold the call. Got 50 something like cents, 55 cents or something like that, and with $49 strike price. My buying price was $48 something like 60 cents. So by doing that, I reduced my average price lower, okay, and now it's expired worthless. I still have shares, and now keeping an eye on them. So I'm going to hold the shares until I see the similar candle when it starts going down and when I sell it. So maybe I will just sell shares if it goes reaches $52, close to this level. If I see again it turns back down, so that's what I'm going to sell it. So I always combine different strategies. I combine buying shares, selling puts, and selling calls. So whatever. Now let's have a look at Dory's strategies. Dory puts that he is going to buy leap calls. Let's have a look. I didn't, for whatever reason, I didn't put for January 2021, so 6 months from now, but we can see nearly 1 year from now. If we go for $50 strike price or $7.50, by the way, you noticed, right? So we don't have already 50 cents increments here, so we have $2.5 difference. But let's calculate how much, let's say, we pay in time value here. So if we take around at the money, so we look at $50, so we pay $5.45. So that would be pure time value, okay? And it means that it's going to be roughly at current share price about 13%, right? If we go for this level, so now we have 48.93, that's the price. So we have $1.40 in like real value, $5.40 minus $1.40, so it's $6.70 minus $1.40, it would be what, $5.30, right? $5.30, close to the same level, okay? So around 12% of, somebody probably calculated it for me, 11%, okay, 11%. And how much is here? So here would be 7%. That would be for 1.5 years, 521 days. So if we look at this level, so it's close to 20% we pay here, like 15% probably, something like that, right? 15% of time value, we're going to pay it. 14%. So you have to consider what option you're going to choose. If you buy it, you also could do diagonal spread, not straight away. Straight away with Intel is not going to work. But if you buy the call with a $47 strike price or $50 strike price or lower, whatever you decide, then what you can do, if you see that the company moved up a bit, and that start going down, you can sell short a call for 5 days or something like that. And look at this. If you pay even $7 for 1.5 years, and after that you sold, we'll say $49 call, you get 53 cents. So it means that roughly 7% you create within 1 week. Okay, but it has to be very short trades. You buy it, sell it at 53, maybe buy it back at 15. So fix like 40 cents. Profit, right, which is going to be around 6% of your investment. If you put $7, if you here it's close to 9% of the profit, and then keep doing it. And you need to do it 10 times in order to completely pay off your investment. So 100% profitability will be here. All right, guys. Do you have any questions regarding that? By the way, what would you prefer? What kind of trades would you prefer here? Would you, like some of you already, Dory and Nick already wrote it, would you buy shares and sell shares? Would you sell puts? Or would you buy calls what would be your preferable strategy? Now you know the prices. Now you know what you can expect here. So what would you prefer here? Okay, Jinlu, roll strategy. Dmitry, shares. All right, great. Sell naked puts. Okay, fantastic. Now, guys, again, I want to repeat, there is no wrong or right thing here. Okay, it's all based on your personality. Whatever strategy you choose is making money for you. Okay, as long as you know how to handle a strategy, when to buy, where put stop losses, if you're doing shares, or how to convert one position to another. For example, as I told you, I put a trade to buy shares and sell shares. Just wanted to do this as Jim doing, like raw strategy. But then as soon as I saw that it's turning around, I instantly converted to another strategy, collected some rent. Okay, that's what you do. Correct. Correct. Of course, it all depends on how much money you place. So, for example, if you trade one contract of Intel, in this particular case, you have to buy 100 shares, so which is 4,900 American dollars right now. Okay. If you buy call, like Dory said, so in this particular case, 100 shares, for 100 shares, it would be $840. Okay, for buying call. But remember, when you buy calls, it's 100% risk. If the share price drops down and stay there for another 1.5 years, it means that all this money is going to be lost. Yeah, spread is not bad. It's like, 5 cents. It's unbelievably good. Okay, yeah. Yeah, because if Dory is performing this trade and he is right, he's going to make at least close to 300% profit. You never do it with all your money. You do it with a small fraction of your portfolio, around 5%. So if you have $10,000, you do it for let's say $500.